Hi, everybody. Chris Englebert with Englebert Financial Advisors in Allentown, Pennsylvania. And guess what? It is November, where we do the first of the month update, and we're going to be talking about what's going to happen in the month of November and possibly the rest of the year. You can obviously see Thanksgiving is right around the corner from my background, and this what I thought was a rather funny cartoon. So let's get right to what's been going on in November. And we now have 6 months in a row of the S&P 500 having positive monthly returns. I keep showing this chart because if you look over on the left-hand side, if you remember earlier in the year, we had a 21% decline when the tariff tantrum first came out. And it was a sharp decline that happened in about 5-6 weeks. And then we turned around and we've rallied to new all-time highs. Now, one of the things that, if you've been watching our videos, and following us, that we've been saying is that the stock market is very fully valued at this point in time. We have sectors in the stock market, particularly the AI chip stocks and the AI companies, that if you look at valuations, they are extremely overvalued by just about any measure that's out there. There was a company that came out this week with earnings, and this is not a recommendation to buy or sell. The company's name is Palantir. Depending upon what measure you look at, the price earnings ratio, or PE, was over 300 on that stock. So one of the things that we've been trying to caution clients about is getting FOMO, fear of missing out. So let's check on some of the other averages right now. We have small mid-cap stocks. And again, if you've been following us this year, we've been a big proponent to small mid-cap stocks. And if you watched some of our other videos, especially the one I did on Trade Talks last month, which is, by the way, on my app. Don't forget to download my app because you can see videos on my app as well. But I talk about how 2026 could be the year of the other 493 stocks in the S&P 500, not just the Magnificent Seven, which are Amazon, Apple, Meta, Microsoft, Nvidia, Google, Netflix. So the point that we're trying to make is that the over-concentration in one particular area in the stock market could soon be over. And that's not to get everybody negative on the stock market, but that's to show you that there's opportunities out there in the other 493 stocks, and also in the small mid-cap stock space as well. There is a historic valuation difference right now between how small mid-cap stocks are trading in relationship to large company stocks. And we think the last couple of months, as the small mid-cap stocks have taken off as measured by the Russell 2000, we think that bodes well for going into 2026. The other thing that we think investors have to pay attention on is what's happening with interest rates. So the Fed made another cut in October of 25 basis points, but some of the chatter that came out of the Fed meeting is that the Fed was signaling that they could be done cutting rates for 2025, which was a little unexpected because everybody expected another Fed rate cut in December of another 25 basis points. But one of the other things that happened is obviously the bond market is concerned about inflation. And after the Fed cut short rates 25 basis points, the 10-year Treasury floated back up to 415, 419. Now, we actually think that's an opportunity, and we think what's going to happen next year is that we're going to go back to a normal yield curve where short-term interest rates are lower than long-term interest rates. The last couple of years, we've had an abnormal yield curve where short rates are as high as long rates. Again, that's not normal, because what ends up happening is investors, companies, they just hide in short-term fixed income like bank CDs. And what you don't get is you don't get the allocation of capital or money to build plant and facilities. You don't get investors looking at investing their money, obviously, in longer term bonds, etc. So we think the message for 2026 is that bonds are going to do well, but you have to be in longer duration or longer term bonds. And we've been saying this for quite some time. So again, something to take a look at, because don't be surprised. You could easily wake up second quarter of next year in 2026 and see bank CDs sub 3%. So let's just sum it up. S&P 500 did 6 months of positive returns in a row. Again, if you watch some of our video, there's a possibility that the Santa Claus rally, which traditionally happens in the early part of December, and the stock market finishes strong for the year, there's a good chance that the Santa Claus rally actually came home came early pre-Thanksgiving. So we're watching what's happening here in November, December. And the question is, are we going to end the year with a whimper instead of a bang? Again, we're seeing the Mag 7 stocks. Earnings have come out. A couple of the Mag 7 stocks had really good earnings, but a couple of them had really poor earnings. And again, we think that this is sending a signal that capital is beginning to leave some of these very overvalued tech stocks. So we had the Fed cut interest rates 25 basis points in October, signaling that they may be done for 2025. So far in November, we've seen interest rates float back up on the long end of the yield curve. We think that's an opportunity going into 2026 to reallocate some of your capital to longer term bonds. So we'll be back in December. We'll wrap up the year for you and give you a little preview of 2026. We hope everybody has a wonderful Thanksgiving, and we'll talk to you soon.